Gold just broke above $5,150 per ounce today, February 23rd, 2026. 4 straight days of gains. A fresh monthly high. And here's the number that should stop you cold. The U.S. economy grew at just 1.4% in Q4 of last year. That is less than a third of the previous quarter's 4.4% rate. Well, while the economy is slowing, gold is accelerating. That contradiction is not a coincidence. Welcome to Market Flux. I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, I break down what the mainstream media leaves out. Subscribe right now because what I am about to show you about gold's move today could completely change how you understand where your money is safe. Let's start with exactly what happened on February 23rd, 2026. Gold registered its highest ever weekly close above $5,100 last Friday. Today, in the Asian session, it pushed past $5,150, a fresh monthly peak. This is 4 consecutive days of gains, and the move is being driven by a specific combination of factors that most retail investors are only seeing the surface of. On the surface, it looks simple. Trade war fears are rising again. Geopolitical tensions are intensifying. The US dollar is weakening. People are scared, so they buy gold. That is the headline version. But that version misses almost everything important. Let us start with what actually just happened on the policy side. US President Donald Trump announced a new tariff framework after the Supreme Court struck down his earlier sweeping tariff plan. The court blocked the broad version, but that did not end the story. The White House came back with a new global levy of 15%, the maximum allowed under the statute, on all items imported into America. This is not a retreat. This is a recalibration. The market immediately understood what this means. Retaliatory tariffs from trading partners, supply chain disruptions, higher input costs across every manufacturing sector. And China's Commerce Ministry responded the same day, urging the U.S. to lift unilateral tariffs on trading partners. That is not a country that is backing down. Now add the Iran situation. U.S. and Iranian negotiators are set to meet in Geneva this Thursday following Iran's submission of a detailed nuclear proposal. At the same time, reports indicate that President Trump is actively considering a military strike against Iran in the coming days. Those two things are happening simultaneously: diplomacy and the threat of war. That kind of uncertainty has one direct beneficiary: gold. Now here's the mechanism that most retail investors completely miss. Think of the US dollar and gold like 2 buckets connected by a pipe. When water flows into one, it flows out of the other. When confidence in the dollar rises, money leaves gold. When confidence in the dollar falls, money floods into gold. This is not a theory. It is a structural relationship built over decades. Right now, the dollar is being hit from multiple directions at once. The US dollar index, the DXY, just pulled back from its highest level since January 23. It is weakening. And it is not weakening because of random market noise. It is weakening for very specific fundamental reasons. Reason number 1, GDP deceleration is alarming. The US economy grew at a 1.4% annualized pace in Q4 of last year. That is a sharp deceleration from 4.4% in Q3. The primary cause was the longest government shutdown in US history, a shutdown that is not a one-time event, but a signal of deepening fiscal dysfunction. When growth slows and dysfunction rises, the dollar weakens. And when the dollar weakens, gold rises. Reason number 2, inflation is staying sticky above the Fed's target. The US PCE price index, the Fed's preferred inflation measure, came in at 2.9% year over year through December. The core measure, which strips out food and energy, hit 3%. That is above the 2% target. The Fed is not cutting in March. But here's the critical nuance. Traders are still pricing in 2 25 basis point cuts somewhere in 2026. A Fed that cannot cut because of inflation, but faces a slowing economy. That is called being trapped. A trapped Fed is a weakening dollar. A weakening dollar is a stronger gold price. Reason number 3, the tariff framework creates a structural inflation floor. A 15% global import levy does not disappear quickly. It is baked into the cost structure of American goods. That means inflation does not come down easily, the Fed stays constrained, and the pressure on the dollar continues. These 3 reasons are not separate events. They are one interconnected mechanism pushing gold higher. Now here is where the story gets more interesting than anything the mainstream financial media is covering. While retail investors are watching gold hit headlines and wondering if it is too late to buy, the big players decided what they were doing years ago. Central banks added 1,082 tons of gold in 2022, then 1,037 tons in 2023, then 1,045 tons in 2024. 3 consecutive years of more than 1,000 tons. That is more than double the average from the decade before 2022. And in November 2025 alone, official reserves increased by another 45 tons. The People's Bank of China completed a 14-month straight buying streak. Poland's National Bank added 83 tons through October 2025, while pursuing a target of raising gold to 30% of total reserves. These are not trade decisions. These are strategic reserve restructuring decisions. Physically backed gold ETFs saw a record $19 billion in net inflows in January 2026 alone. Total gold ETF assets under management reached $669 billion globally. That is not retail money chasing a trend. That is institutional capital making a permanent allocation shift. The World Gold Council's 2025 Central Bank Survey showed the strongest intention to continue buying gold since that survey began in 2019. A near majority of central bankers, 95%, expect global central bank gold reserves to increase over the next 12 months. While retail investors were told the dollar was strong and rates were high and gold would struggle, the institutions and central banks were quietly accumulating at scale. While you were told to expect a correction, they were building their largest gold positions in recorded history. Goldman Sachs projects gold reaching $4,900 per ounce by December 2026. JP Morgan's private banking division sees $5,200 to $5,300 by year end. Bank of America and JP Morgan both see a clear path to $5,000. The most aggressive institutional forecast comes from Yardeni Research, which has $6,000 on the record for year end 2026. That is the gap between what retail investors are being told and what institutional capital is actually positioned for. And the most important part of this entire story, the part that explains not just where gold is today, but where it is going next, is something most people have not connected yet. Let us go back to 2018 to understand exactly what is happening right now. In 2018, Trump launched his first trade war with China. Tariffs went on. Markets panicked. The dollar spiked initially. Most retail investors sold gold expecting dollar strength to crush it. Gold dropped to $1,174 in August 2018. That looked like the end of the bull case. Then something shifted. The Fed paused its rate hike cycle. GDP growth slowed. The dollar stopped climbing. Gold went from $174 in August 2018 to $157 by September 2019. A 32% move in 13 months. The same playbook is now running again. But this time the numbers are significantly larger and the structural forces are far more powerful. The difference in 2026 is that central banks are not waiting on the sidelines like they were in 2018. They are already fully committed and still buying. Now let us look at what has not changed. The fundamentals that are still fully intact underneath this price move. First, the physical supply deficit is not going away. Global gold mine production grew by less than 1% in 2025. Demand from central banks, ETFs, and jewelry sectors combined is outpacing new supply by a measurable margin. You cannot print gold. That supply constraint is structural and permanent. Second, de-dollarization is accelerating. The BRICS nations, Brazil, Russia, India, China, South Africa, and their new members, are actively reducing dollar dependence in trade settlement. Every step away from dollar-denominated trade increases the relative demand for gold as a neutral reserve asset. This is not a political talking point. It is showing up in reserve data from the IMF and World Gold Council every single quarter. Third, the Fed is structurally constrained. With core PCE at 3.0% and GDP at 1.4%, the Fed faces a stagflation-like scenario. It cannot cut aggressively without reigniting inflation. It cannot hike without crashing a fragile economy. That paralysis keeps real yields suppressed, and suppressed real yields are historically the single most powerful driver of gold's long-term price appreciation. Fourth, geopolitical fragmentation is not a short-term event. The US-Iran situation, the Russia-Ukraine conflict now entering its fourth year, Taiwan's Strait tensions, and the breakdown of multilateral trade rules. These are not temporary shocks. They are the new operating environment. In that environment, gold is not a trade. It is insurance. Now, on the record, screenshot this. Gold will reach $5,500 per ounce by June 30th, 2026. Here is why that number is specific and defensible. Gold is currently at $5,150 today, February 23rd. The MACD on the 4-hour chart is extending above the signal line and above zero. The 200-period EMA sits at 4,964. Gold is trading $280 above that level. The RSI is at 73.23, which signals overbought conditions in the short term. That means a brief consolidation or minor pullback is likely in the next 2 to 3 weeks. But the structure is bullish. After that consolidation, the path toward $5,500 opens. As the Geneva negotiations play out, tariff retaliation accelerates from U.S. trading partners, and 2 expected Fed rate cuts get priced more aggressively into markets. $5,500 by June 30th. That is the call. Now, let us talk about scenarios with real probabilities. Scenario 1, Gold consolidates briefly and then breaks $5,500 by June 2026. Probability, 60%. This assumes the Iran nuclear talks collapse, tariff retaliation from the EU and China escalates, and the Fed signals rate cuts at its March or May meeting. All three of those conditions are currently trending in this direction simultaneously. Scenario 2. Gold trades sideways between $4,900 and $5,200 through mid-2026 before making a new leg higher in Q3. Probability, 30%. This happens if Iran and the US reach a partial deal in Geneva, dollar stabilizes temporarily, and the Fed delays rate cut signals longer than the market expects. This is not bearish for gold. It is a delay, not a reversal. Scenario 3. Gold pulls back to the $4,600 to $4,700 range on a surprise strong dollar event or a major risk-on rally in equities. Probability, 10%. This would require a sudden resolution of both the Iran situation and trade war simultaneously, plus a blowout GDP print. Possible, but not the base case by any current data point. Now let us talk about what you should actually do based on where you are right now. If you are holding physical gold, bars, coins, allocated accounts, understand this. You are positioned correctly. Do not let short-term RSI overbought readings shake you out. The institutional thesis has not changed. Your job is to hold and not panic during the consolidation that is likely coming in the next 2 to 3 weeks. If you're using leverage or trading gold actively, be very careful in the next 10 to 14 days. RSI at 73.23 is a warning. A pullback to the $4,950 to $5,050 range is possible and would be healthy. Do not chase this move at $5,150 with leverage. Wait for the consolidation entry. If you are sitting on the sidelines with cash, the question is not whether to allocate to gold. The question is at what price. A pullback into the $4,900 to $5,050 range is your entry window. That is where the 200-period EMA cluster and previous resistance turned support converge. That is the zone to watch. If you bought at recent highs and are feeling the pressure, understand that the structural thesis is intact. The GDP data, the tariff framework, the central bank buying, and the Iran situation have not resolved. If anything, they have intensified since you bought. Panic selling a structurally sound position because of short-term RSI is how retail investors consistently transfer wealth to institutions. Now here is what you need to watch going forward. Watch the DXY, the US dollar index. If it breaks below the 97.00 level and holds there, gold's path to $5,500 accelerates significantly. If it bounces back toward 9 when it will to 100 out in Wanners, expect the consolidation scenario to play out first. Watch the Geneva negotiations on Thursday, February 27th. If talks collapse or Trump announces military action against Iran, gold gaps higher immediately. If a preliminary agreement is announced, expect a short-term pullback. Watch the March Fed meeting and specifically the language around rate cut timing. Any shift from patient to considering adjustments in Fed language will trigger immediate gold buying. Watch World Gold Council monthly reserve data. If central bank purchases come in above 50 tons for February 2026, that confirms the institutional accumulation trend is not slowing down. Now, let me tell you about the 3 types of people watching this right now. The first type is panicking. They bought gold somewhere in the last 6 months. They see RSI overbought warnings. They read a headline about a possible Iran deal, and they are already reaching for the sell button. They will sell at $5,100. The price will consolidate to $4,150. They will feel smart for 2 weeks, and then gold will push to $5,400, and they will buy back in at a higher price than where they sold. This is the most expensive mistake in markets. The second type is frozen. They have been watching gold for 2 years. They know the thesis. They agree with the data, but they keep waiting for a better entry that feels more comfortable. They watch gold go from $2,000 to $3,000, then from $3,000 to $4,000, then to $5,000. And they are still waiting. Paralysis is its own kind of loss. The third type is learning and preparing. They are watching these indicators, they understand the mechanism, they have a plan for the pullback scenario, and they are not making emotional decisions. That third type is who this channel exists for. Markets have always moved wealth from the impatient and uninformed to the patient and prepared. That is not a cynical observation. It is the documented history of every major commodity cycle in the last 100 years. The people who understood gold's role in a deteriorating dollar environment in 2018 were rewarded with a 32% move in 13 months. The people who understood it in 2022, when central banks began their record buying streak, have watched gold more than double. The mechanism has not changed, only the scale has. Gold broke above $5,100 for a reason. It is not random. It is not speculation. It is the market telling you something very specific about what the big players believe is coming next. If this video showed you something the mainstream financial media is not telling you, hit the like button right now. Subscribe to Market Flux. I do this every week, so you are never caught off guard while everyone else is distracted. Share this video with one person who is sitting on cash and wondering what to do with it right now. And tell me in the comments, are you in the gold trade or still watching from the sidelines? Drop your answer below. I read every single one. This is not financial advice. Always do your own research before making any financial decision.